Appendix H, payroll accounting. Here in Appendix H, we're going to look at how an employer will account for the payroll, what it's paying to its employees. We're going to first talk about how to calculate and then record payroll. Then we're going to look at some taxes that the employer has to pay. And then very briefly at the end, we'll talk about the objectives of internal control for payroll. We'll talk more about internal controls when we get to Chapter 7, but we'll talk about a couple of things here in Appendix H. Now, for many of you, this section of our accounting textbook that we're going to cover, some of the things are going to be kind of familiar to you because you've had summer jobs or you're currently working a part-time job after school or on weekends or anything. So some of these terms are going to be familiar to you, so you're not going to be totally ignorant walking into this section of our textbook. So first thing we're going to look at, what is payroll? Payroll is when an employer pays its employees. And an employer can pay its employees a lot of different ways. It can pay their employees on a salaried basis, in which case the employee is going to earn the same amount each pay period. Or there could be an hourly wage employee, and the employee works so many hours and gets paid so much per hour. There are other ways to determine payroll. You might have an employee, usually a salesperson, who is paid on commission. So depending upon how many things they sell on behalf of the employer, that will determine what their pay is going to be. Sometimes you might see an employee on a salary plus commission or an hourly wage plus commission. So there can be a lot of variables there that go into determining the payroll. Sometimes an employer might pay their employees on what's called a piece rate. In other words, usually that's going to be producing something, so however many items an employee produces, they get paid so much per item. I think it's still going on this way out at Cooper Tire, but Cooper Tire and Rubber Company pays its tire builders on a piece rate basis, so much per tire. The only piece rate job I've ever had is I hauled hay one summer on a family farm, and I got paid so much per bale of hay. Not a fun way to be paid for sure. Okay, so no matter how the employer determines how they're going to pay their employee, the first thing they have to do is calculate the gross earnings of the employee. So whether it's a salaried employee, an hourly wage employee, commission, salary plus commission, whatever, they have to determine the gross amount that the employee has earned. Now, that's going to be called our gross earnings. Now, this is not what the employee receives on their paycheck or their direct deposit. For those of you who have had a job and have worked, one of those first welcome to the real world moments you might have had is when you got your first paycheck and you were expecting to be paid a certain amount because you'd worked so many hours, and you multiplied that by your hourly wage rate. But then you found out there were some things called payroll deductions. There are things that are deducted from your gross earnings to determine your net pay, or the amount of money that is received by the employee, whether it's through a paycheck or perhaps through a direct deposit into a checking account. So we're going to look at how to determine our gross earnings, our payroll deductions, and our net pay here as we go forward. Okay, this is a simple example of calculating the gross earnings of an employee who is working on an hourly wage rate. And you see this employee has worked 44 hours. Now, if the business falls under the Fair Labor Standards Act, which most businesses do, not all, there's some exceptions, we're not going to get into those exceptions, but most employers are required to pay their employees overtime if they work more than 40 hours per week. And in this case, this employee has worked 4 hours of overtime, 4 above the 40 hours. And their hourly wage rate is $12. So this employee, for those hours that are worked over 40, is going to earn 1.5 times their regular hourly wage rate for those 4 hours they work in overtime. So 1.5 times 12 gives us an overtime rate of $18. So this employee is going to earn $12 per hour for the first 40 hours, or $480. And then for their 4 hours of overtime, they're going to earn 1.5 times, or $18 per hour, for a total of $72. So the total gross earnings of this employee during this pay period is this $552. All right, now let's talk about the payroll deductions. Some payroll deductions are mandatory or involuntary. The employee does not have a choice. The employer is required to withhold an amount from the employee's paychecks. Others are considered voluntary. These are amounts the employee chooses to have withheld from their paycheck. And there's a lot of different voluntary deductions. Here are just some examples. You can make charitable donations. The United Way likes to get employers to get their employees to make contributions to them so much per pay period. Some type of insurance, whether it be health insurance or life insurance. If they're a member of a union, there might be union dues. Any type of retirement plan, including this pension plan, that could be withheld. So these are all voluntary, the employee chooses. These three are the mandatory ones. We're going to spend more time talking about these. All right, let's talk about the mandatory payroll deductions. The first one is the FICA tax. The FICA tax stands for Federal Insurance Contributions Act, that was passed back in the 1930s. The FICA tax is made up of two taxes, actually, the Social Security tax and the Medicare tax. The Social Security tax is 6.2% of an employee's gross earnings. The Medicare tax is 1.45% on gross earnings. Now there is a limit, or a maximum amount of an employee's gross earnings that are taxed, and during 2018 that ceiling is $128,400. It changes usually from year to year. Some years there's no change, but for the most part it has been creeping up. You can see what is X'd out there when this book was published, and I want to say that was probably, I can't remember how many years ago, but it was $110,100. So you can see it's gone up several $1,000s over the last several years. So as soon as an employee reaches $128,400 in gross earnings for the year, the employer will no longer withhold Social Security tax. But Medicare taxes, there is no ceiling. If you earn $1 million a pay period, all $1 million is going to be taxed at 1.45%. No limitation. And again, Social Security is to provide for retirement, employment disability, and medical benefits. The medical benefits, that's going to be part of the Medicare tax. So when you reach a certain age, you can apply to draw your Social Security and also be covered under Medicare. The next mandatory deduction is for federal income tax. Employers are required to withhold for federal income tax. We operate under a pay-as-you-go system, so you will pay each pay period a certain amount towards your ultimate tax liability. That's because I know the federal government at one time figured out that people aren't going to set that money aside in order to pay their taxes, so we pay as we go. Now this federal income tax that's withheld is an estimate of what the government thinks you're going to owe in taxes. So when you, at the end of the year, when you're filling out your Form 1040, your personal federal income tax return, you're going to calculate how much tax you're supposed to pay on your gross earnings, and you're going to be able to take deductions and all these things. And anyway, you come up with how much tax that you owe. you're going to compare that to what you've paid in, what you've had withheld by your employer, and then if you've had more withheld than you owe, then you can apply for the refund. If you have not had enough withheld, then obviously you're going to have to pay some in when you file your tax return. How the employer determines how much they're going to estimate to have withheld from each employee's paycheck is going to be depending upon what goes on the Form W-4. When you go to work somewhere, one of the first things you're going to do is the employer is going to have you fill out IRS Form W-4. This W-4, you're going to put your marital status on there that you're going to claim, and also how many allowances you're going to claim. And the more allowances you claim, the less that will be withheld. I'll show you how that works here in a few moments. But that's how the employer determines how much to withhold. This is the Form W-4 that is filled out and given to the employer. The employer keeps it. That's their record to show or to document how much they're going to have withheld from your paycheck. Obviously, you're going to put in your name, social security number, address, and then here on Block 3, you're going to claim a marital status, either the single, married, or married but withhold at the higher single rate. On line 5, you're going to record how many allowances you're going to claim here, and I'll show you here in a minute the effect the number of allowances has on how much is withheld. And if you want to have an additional amount withheld, maybe you've got another job out there, you're kind of self-employed, you paint houses on the weekend, separate and apart from your normal job, and you're earning income that you're going to report on your tax return, but no monies are being withheld on those painting jobs that you're doing. So you decide you're going to go to your employer and have an additional amount withheld. You don't want to have to pay in a whole lot when you file your tax return, because the IRS can hit you with what's called an under withholding penalty. So you can pay in when you file your tax return, but if the amount's too large, the IRS could hit you with an additional fee. If you don't earn a lot of money and you really are not going to have to pay any income taxes, I used to tell my high school students that a lot of them just had part-time jobs or jobs in the summer. They didn't really earn enough to be able to have to pay income taxes, but the employer would withhold taxes. And so to keep that from happening, you can write the word exempt here on line 7. And again, if you qualify for this, which basically says last year you had a right to refund of all your taxes because you didn't have a tax liability. And then this year you expect the same to occur. You can write exempt there, and the employer will not withhold any taxes. If you have taxes withheld and you end up not having any tax liability, the only way you're going to get that money back is if you file a tax return. So if you don't think you're going to have to pay have any tax liability, and you don't want to have to file a return, write exempt there, and the employer won't withhold anything. Again, you're going to sign it, date it, give it to your employer. Now, this publication 15, I've shown you the front page of that publication. It's called Circular E. It's the employer's tax guide. It's kind of the Bible for people who do payroll, because it answers just almost any question an employer might have as far as doing their employees' payroll. We're going to look at some different sections of this employer's tax guide here in the next couple of slides. This is an excerpt from that publication. Each year, the IRS issues this publication. So this is the publication for 2018. You can see what the Social Security tax rate is, and it shows what the base limit is. There's that $128,400 that we talked about a few slides ago. So that's how an employer knows what the ceiling is in a given year. Okay, here's a portion of the wage bracket method tables, and I wanted to use it to show you how the number of allowances an employee claims, the effect that has on how much taxes are withheld. So I'm using the table. There's a table for single persons or married persons, and they're set up based upon what type of or how often an employer pays their employees. This is one for married persons for an employer who pays semi-monthly. That means twice a month. Usually when an employer pays their employees twice a month, they'll pay them on the 15th of each month and the last day of each month. So there's 2 paychecks or 2 pay periods per month. Some employers pay their employees weekly. In some cases it might be bi-weekly, which would mean every 2 weeks. So an employee gets 26 paychecks per year every 2 weeks, 52-week year. It could be a monthly paycheck. There's tables that are set up for monthly payroll. So there's a table set up for almost any type of or any way an employer pays their employees. But I'm just showing you an excerpt from the tables. And this is for a married person, and the employer pays them on a semi-monthly basis. All right, over here in this column right here, you have the employee's gross wages. So let's just assume, for the sake of this example, that the employee has earned $1,850 during this semi-monthly pay period. So that $1,850 is going to fall between this $1,845 and the $1,865. So if the employee earns that $1,850, then the employer would look in this wage bracket table, and if the employee has claimed 0 allowances on their W-4, the employer is going to withhold $149. If they claim 1 allowance, they're going to withhold $128. 2 allowances, $107, and then so on and so forth until, if they have claimed 8 allowances, that means the employer is not going to withhold any taxes. So again, the more allowances you claim, the less that will be withheld from your paycheck. As I said earlier, you got to be careful with this, because you think, gosh, I want more money now, so I'm going to claim a ton of allowances so my employer won't withhold any taxes. And then you get down to the end of the year and you file your tax return and you owe this huge sum of money to the federal government, and they're not going to be too happy with you, so they're going to hit you with what's called an under withholding penalty for your failure to have enough withheld. Again, you can write a check to the IRS when you file your tax return, but if it's too large, they can hit you with a penalty. So you kind of want to try to get it close if you can. Okay, the last mandatory deduction would be for a state income tax. Now every state that has a state income tax has their own rules and requirements. Texas does not have a state income tax on your personal earnings. Arkansas does. Louisiana does. Florida does not. So again, every state is different. For the purposes of different examples and problems in this appendix, they're going to give you a rate that you're just going to apply to the gross earnings. I think most of the time you'll see like 2%. Just understand that each state has their own set of rules. Now, there are some cities that have an income tax. It's called a municipal income tax. New York City is one of those. So if you work in New York City, you will pay on your gross earnings, you will pay a federal income tax, a New York state income tax, and a New York City municipal tax. So those earnings get taxed 3 different times. Okay, going back to our example, we had our employee who had gross earnings of $552. The employer calculates the FICA taxes, remember the Social Security tax and the Medicare tax. Social Security tax is 6.2%, Medicare tax is the 1.45%. That's the 7.65% right here. So 7.65 of the $552 gives us a FICA tax of $42.23. Based upon what this employee showed on their W-4, the employer estimates that the federal income tax that needs to be withheld is $49. State income tax $11.04, and this employee chose to have two voluntary deductions made, United Fund and then union dues, for a total of $15. Total payroll deductions are $117.27. We subtract that from our gross earnings of $552, and then the employee's net pay is $434.73. That's how much the check will be for if they get a paycheck, or that's how much will be direct deposited if they operate under that form of payment. Here's one of the records that an employer will be required to keep. This is called the employee earnings record. So they'll keep this for each employee. Now, obviously under a computerized payroll system, the computer will be keeping up with it, but if it's a manual system, this is what it would look like. So for every employee, we're going to have this employee earnings record. In this case, it's for our one employee, Michael Watson. And it shows every time we pay Michael Watson a paycheck, or there's a payroll where he earns some type of wage or salary, we're going to record how much the gross earnings are for that employee, what the FICA taxes that were withheld, what federal income taxes that are withheld, state income tax, and these voluntary deductions, total deductions, and this is the net pay that they received. We're going to keep this record for a variety of reasons. For one reason is this is going to be where the employer gets all the information to prepare the Form W-2. We'll look at a Form W-2 here in a little bit, which is what the employer is going to give to the employee at the end of each year, and this is what the employee is going to use to prepare their personal tax return. A copy is also being sent to the IRS. Also, we're going to keep a cumulative gross earnings for this employee. So on January the 14th, when they earn this $552, we're going to add it to the $516 they earned on January the 7th. Now their cumulative gross earnings are $1,068. And each time we pay Michael Watson an amount, we're going to take the gross earnings that he has and add it and keep track of this total. For several reasons. Number one, if this employee reaches that Social Security maximum of $128,400, this is where it'll show the employer to quit withholding Social Security taxes. Also, when we look at some of the employer's taxes here in a minute, the employer is required to pay two types of taxes, a federal unemployment tax and a state unemployment tax on the first, like say $7,000 of their earnings. So from an employment tax perspective, as soon as the employer, or as soon as the employee reaches a certain gross earnings, the employer no longer has to pay those unemployment taxes. We'll look at that here in just a little while. So we've got this employee earnings record that we're keeping track for each employee. Here's another record the employer is going to have to keep up. It's called a payroll register. A payroll register will be prepared every time the employer pays its employees. So we're not showing all the employees, we're just showing a few select ones, but you can see this little squiggle line right here. That means there's other employees in there somewhere, but we're just not showing them on there for the sake of space. The payroll register will give the employer all the information needed to record the payroll into their accounting records. And we'll look at the entry that is made to record this particular payroll. This is for the week ending January the 14th. But you can see all of our employees that earn some type of pay during the week ending January 14th are listed here. We show their gross earnings, their FICA taxes, all their different deductions, what their net pay was. Now this column right here is kind of redundant because we actually show that same thing here in this column, but Anyway, all of this information shown here gives us the journal entry to make to record our payroll. And you're going to see that here in just a second. What we're going to end up doing is debiting salary and wages expense for the total gross earnings of our employees, the $17,210. We're going to credit a bunch of different liability accounts for all of these withholdings, because if you'll think about it, when we withhold these amounts from our employees' paychecks, these monies don't belong to the employer. They belong either to the federal government, in the case of FICA taxes and federal income taxes, or the state government for their state income taxes. United Way is owed this $421.50, and the union is owed this $115. So we're going to credit a different liability account for these different types of payroll deductions. Let's look at that now. So to record the payroll from the payroll register we just looked at, the first thing we're going to do is debit salary and wages expense for the total gross earnings of our employees, the $17,210. We're going to credit FICA taxes payable for the amount of FICA taxes that were withheld from our employees' gross earnings, the $1,316.57. We're going to credit the federal income tax payable account for the amount of federal income taxes that were withheld, the $3,490. We're going to credit state income taxes payable, $344.20. That was the total amount of state income taxes that were withheld from our employees. We're going to credit United Fund contributions payable for the $421.50. And then we're going to credit union dues payable for the $115. Now, we know from previous chapters that anytime we make a journal entry, our debits have to equal our credits. So we've got one more credit to make, and that is going to be to an account, a liability account called salary and wages payable. This is the total net pay of our employees. This is what we owe, the money we owe to our employees, which is their net pay, the $11,522.73. And then when we pay our employees, we're going to debit that liability account, credit our cash account. Okay, this is an example of a paycheck that an employee might receive. This is the total net pay that this employee is supposed to receive. When an employer pays their employees, they are required to give them a copy or have available to them information that's shown here. This is called the pay stub, that basically shows everything that appears on both our employee earnings record and our payroll register, which is going to be the total gross pay less all the different deductions, and then what the net pay is. Of course, that's going to agree with that right there. And then there's going to be an accumulation here that shows the total amount that's been accumulated in each of these types of deductions for the year. Again, they either are required to give them this with their paycheck or have this available to them. Here at the college, I don't get a copy of my pay stub. We have direct deposit, so my monies are, the net pay I receive is deposited into my checking account, but I have access to that on our system here, where I can go and look at this pay stub information anytime I want to. Okay, a question. Net pay is equal to hopefully you said gross earnings minus payroll deductions. Another question. On which federal form does the employee indicate the number of allowances claimed for withholding federal income taxes? The form W-4. The form W-2, that's the form we're going to look at in a minute. That's what shows the employee for the entire year what was earned by the employee and the amount of the different deductions that they used to complete their federal tax return. don't know what a W-1 is, a W-3 is a transmittal form that goes along with the W-2 when the employer sends the W-2 information to the IRS each year. Okay, we just looked at the calculation of the gross earnings for the employee and all the different deductions that are withheld from the employee's paycheck. Now let's look at what the employer has to pay because they have employees that they're paying salaries and wages to. The employer is required to pay FICA taxes, federal unemployment taxes, and state unemployment taxes. So the FICA taxes that the employer is required to pay is going to match those that are withheld from the employee's paychecks. So basically what is occurring here is for our FICA taxes, the employee is paying half, the employer is paying half. So don't ever complain to your boss or your employer about the FICA taxes because their response to you is probably going to be, I have to pay them too, so don't complain to me. So the same rate, the same 6.2% on the gross earnings for Social Security, the same 1.45% for the Medicare taxes. So 7.65% are the FICA taxes. Now, if a person is self-employed, in other words, they're not getting a paycheck, they're a painter or they have a lawn mowing service, they're a self-employed individual. The self-employed individual is not going to have monies withheld from their paycheck. They're the owner of the business, self-employed, but they're going to have to pay what's called a self-employment tax. The self-employment tax on self-employment income is going to be twice this rate. So multiply that times 2 and you get the self-employment tax of 15.3%. So a self-employed individual has to pay basically both parts of it because they're both the employee and the employer. All right. The next employer payroll tax is the federal unemployment tax, or the FUTA tax. This shows that the FUTA tax is 6.2% of the first $7,000. It's actually 6.0% right now. They actually lowered that a year or so ago. But don't worry about the rate as much as just understanding that it is one of the employer payroll taxes, and it's on the first $7,000. Problems in your textbook will be at 6.2%. They'll give you that rate. But the federal government gives employers a 5.4% credit if there is a state unemployment tax system that they are making payments to, timely payments to. So in effect, the real federal tax rate is 0.8%. That's the 6.2% minus the 5.4%. Obviously now it's going to be 6.0% times the 5.4, which is going to be 0.6%. Every state has their own separate state unemployment tax system. We're going to operate and keep it simple here in this appendix. We're going to assume that the state rate is always that 5.4% on the first 7,000. Again, every state has their own separate deal. It might be 5.4% on the first 9,000 or the first 12,000, or it may be a different percentage. Don't worry about that so much. Just understand that each state does it differently, but the federal government gives employers a credit of 5.4% for federal purposes, and then again the state rate, again, we're going to assume to be that 5.4%. So going back to our example we were looking at a few moments ago of the payroll we did for the week ending January the 14th, to calculate the employer's payroll taxes, ignore this first one, the debit here. We're going to talk about the credits here first. We're going to credit FICA taxes payable for the total gross earnings, the $17,210, times our FICA rate of the 7.65. Remember, the 7.65 is made up of the Social Security tax of the 6.2 plus the Medicare tax of the 1.45. So a total of $1,316.57. We're assuming our federal unemployment tax rate is going to be our 0.8%. So 0.8% times 17,210 gives us this federal unemployment tax of $137.68, which is what we're going to credit federal unemployment taxes payable, and then our state unemployment tax payable is going to be credited by the 5.4% of our gross earnings of the 17,210 for a total of $929.34. Now let's go back to our debit, to our payroll tax expense, because this is an actual expense to the employer. The $2,383.59 is just the total of these three right here. So we really don't know what to debit payroll tax expense till we calculate these three taxes: the FICA tax, the federal unemployment tax, and the state unemployment tax. Another question: employer payroll taxes do not include federal income taxes. Remember, the employer payroll taxes include the FICA taxes, the FUTA taxes, the federal unemployment taxes, and the SUTA taxes, the state unemployment taxes. And another question: which of the following taxes is the only one paid by both the employee and the employer? And of course, that would be our FICA taxes. Remember, only the employer pays our unemployment taxes. The employee does not. Okay, there's a lot of reports that have to be filed. There's a lot of paperwork, a lot of detail in keeping up with payroll and payroll taxes. The employer has to report to the federal government the FICA taxes and federal income taxes they're withheld. They do that on a quarterly basis on Form 941. They're also going to have to send in federal unemployment tax information on Form 940. The employer is going to have to give to the IRS and the employee Form W-2. This is going to be, we're going to look at that here in a minute. They're supposed to do that by January the 31st of each year for the preceding calendar year. If you receive a W-2 from your employer, you need to make sure you put that information on your tax return, because the IRS is receiving a copy of that information as well. What you also want to make sure is if you leave a job and go get a job somewhere else, and then you change your mailing address during that time, you want to make sure your former employer knows your new address, because they're going to mail that W-2 out to whatever address they have in their files, and it may get sent out and it may get returned to them because you've moved. And let's say you only worked for a month, the month of January, for an employer. Then you got a new job, you began working there, and then you got a new you moved to a different house or different apartment, you changed your mailing address, and then you go to fill out your tax return the next year, and your new employer gives you the W-2, and then you kind of forget that you worked for the month of January for your former employer, and you forget about that information, and you never get a W-2 because your old employer doesn't have your new mailing address, and so you file your tax returns and you've left off that January payroll information. Guess what? The IRS is getting a copy of it, so your tax return is not going to be accurate. Here's a copy of the W-2 that each employer is required to send their employees. Again, there's going to be the employer's name, the employee's name. There's going to be the total gross earnings of the employee, the total federal income tax that's withheld, and of course Social Security tax, Medicare taxes as well. And then if there's a state income tax withheld, that's going to be shown down here at the bottom. When the employee files their personal tax return, this is going to belong on their personal tax return. Also, this federal income tax withheld is going to be used on their tax return. Sometimes you'll see Social Security taxes and Medicare taxes amounts are different from the total gross earnings. What would create this type of situation is if an employee is ever having an amount withheld, what's called pre-tax. In other words, some of their earnings aren't going to be taxed because they're having amounts withheld for like a 401k, some type of retirement plan. Some employers participate in what's called a cafeteria plan, where perhaps some health insurance amounts withheld for health insurance are withheld and they aren't taxed currently. So sometimes you'll see different amounts here. So if you ever see that, you'll know what's going on there. When we get to Chapter 7, we're going to talk about internal controls, and we're going to look at some of the objectives of internal controls. And one of them is going to be to safeguard assets, and one of the objectives is going to be to make sure our accounting records are accurate. As that applies to payrolls, is you want to make sure your payroll information is accurate because you want your employees to be paid the correct amount. You don't want them to be paid too much. You don't want them to be paid too little. And obviously you want the amount of calculation of the taxes and things to be withheld to be accurate. And then as we're making entries into both our accounting records and also having to prepare reports that are going to different government agencies, we want those to be accurate as well. It is it's a huge issue to mess up those reports. It requires a tremendous amount of time to get those corrected if you filed reports that turn out to be not accurate with either IRS or the different state government agencies. So you want to make sure they're accurate. And this last slide just shows some different control features and how you try to prevent fraud that might go on within a payroll function. Again, we'll talk more about fraud prevention and internal controls when we get to Chapter 7.